Today's Talk About It Tuesday question is, what's the best way to get a mixed-use property if you have equity in your current home, but your FICO score is not good? Okay, so let's define a couple of things from the question. So what is a mixed-use property? So a mixed-use property is a combination of a commercial and residential property in one. So most often you'll see that manifested as on the ground floor, there's a storefront, and then the units above it are residential, they're apartments. But it can be in any configuration, but that's usually what you see most commonly. On the ground floor, you'll see, like I said, a storefront or commercial space, and then above it, apartments. So that's a mixed use property. That is usually not somebody's first property. It's usually something that you will purchase for cash flow as a second property. And it's important to understand the distinction for the lender of a primary residence first property and a property you intend to use for cash flow, right? Because they understand that your personal investment, your emotional investment, your personal commitment to saving it is different when it's your home as opposed to a commercial space where if you get into financial trouble, you'll much more likely let go of the commercial space than you will your home. You'll fight for your home. So keep that in mind when you're thinking of the mindset of a lender, especially when you're saying, I'm not fully fit to be a borrower because my FICO, which is your credit score, is not where it needs to be to look good for creditors, for lenders, right? So I'm going to give you 5 good alternatives when you don't have a very good FICO score. And FICO score is not the only criteria depending on the type of lender, right? So usually we think of a traditional lender like a regular bank. And yes, your FICO score is going to be super critical. Your income is going to be super critical. Your cash reserves will be super critical from a traditional bank lender. But let's look at some alternatives. So one thing you can do is try to get an FHA loan, because the criteria is a little bit different than most banks, right? And so for a mixed use property, if 51% of the property is residential and you have at least a 580 credit score, you can get an FHA loan, to finance your mixed use purchase. The down payment will be very large. And in most cases, again, because it's commercial, you're going to see between 20 and 40%, depending on the type of lender, down payment, right? Where if you're a first time home buyer, 4%, right? Other residential, maybe up to 10%, but commercial, you're going to see between 20% and as high as 40%, depending on the type of lender and depending on your condition. So we have FHA, which is an option. Then we have hard money. So what is hard money? Some of you have probably heard that term. Use a hard money lender. Hard money lenders are private lenders. There are thousands of them that you can find on the internet in your region based on where you're at. And hard money lenders will not always look at your credit score. They might look at your credit score, but that will not be the determining factor as to whether or not they lend. They look at the value of the property. So they want to make sure there's a lot of equity left for them if you default, that they can foreclose on and sell that property and recoup what they put out. So based on the property value, they will lend to you. But again, the down payment can be as high as 40%. They might give you 65%. They might give you maybe 70%. Then you're not usually going to go much higher than 70, maybe 80% of the value of the property, not the purchase price, but of the value, right? So 65% loan to value could cover the purchase price. It might cover the total purchase price, but they want to make sure there's a lot of equity left, and the terms are serious. So if you were in a great condition and you were someone who'd done a lot of deals, you might get as low as 8%, but in general, you'll get up to about 15% interest on a loan, and the terms of the loan are usually 1 year, and it balloons at the end of the year. But sometimes can go as high as 5 years, but not usually. Usually 1 year, maybe 2 years. Maybe there's an option to extend to 2 years. But then the whole payment balloons, which means you will have to have fixed your situation so that you can refinance out into a traditional loan. But to acquire it, you can use hard money. Three, you can do seller financing. So what is seller financing? Seller financing is usually someone who owns a property who does not currently have a mortgage on it, who is selling it and is not in need of the entire amount up front. So in general, what you would do is you would make a deal with them to act as the bank, right? You would make terms and conditions with them and pay them the monthly payments until it is paid off. And they have a right to sell that note to someone else if you're paying. So seller financing is a good option. You can do a DSCR loan. Some of you probably heard this. Debt to service. Now, what is it? Debt to service coverage ratio loan. So a DSCR loan is based on the cash flow that the building can make. So the loan is based on, okay, can this thing cover all the cost of servicing the debt? We'll lend you based on that. So again, your credit doesn't become a major issue. The terms aren't always great for that either. So you'd probably refinance later into a traditional mortgage after performing in a DSCR loan. And five, partner with an investor who's in a better position to be able to get financing, right? And so you don't get 100% of the deal. You get whatever percentage you can get with this partner who's bringing the money, right? Maybe you're bringing the down payment, right? But they're bringing the financing, and so you make a good deal. So you got to look at the position you're in, and in any case, what will improve your position if your credit score is low, and you should be working on that because maybe you just need to get patient and improve that so your options are better. But you're going to need a high cash reserve for some of these, what's the cash reserve? Maybe up to 6 months worth of what the mortgage payments would be. Some lenders are going to look at that and say, well, just make sure you have some money in case things don't go right. You're going to either need to show income that can cover the cost of the debt or cash flow from the property that will cover the debt, which means, thirdly, you'll also need to get a strong appraisal for either the equity value, especially if you're doing the hard money, or the income value in terms of rental income it could produce, especially with the DSCR. So those are the alternative ways to not being in a perfect condition and not being able to use a traditional bank to finance a mixed-use property, but 100% doable. Listen, I do these kind of consultations all day long. So if you have a situation like that, come see me. Just schedule an appointment and I get you through the tough deal. So I'd love to hear some strategies that you were considering, you might have used in the past, but please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.